Revenue recognition is governed by robust accounting standards ASC 606 IFRS 15 that require careful application of a 5-step model, significant management judgment, and strict legal compliance. Failure to adhere to these principles can result in severe regulatory, financial, and reputational consequences. Revenue recognition is the process of recording revenue in financial statements when a company satisfies its contractual obligations to customers. Under current standards ASC 606 IFRS 15, revenue is recognized based on the transfer of control of goods or services using a 5-step model. Legally, companies must maintain strong internal controls, comply with disclosure requirements, and avoid practices that misstate revenue, as violations can lead to SEC enforcement, financial penalties, and even criminal liability. Revenue recognition under ASC 606 and IFRS 15 follows a 5-step model, identifying the contract, determining performance obligations, setting the transaction price, including variable consideration, allocating the price to obligations, and recognizing revenue when obligations are satisfied. Revenue is recognized when control of goods or services transfers to the customer, not just when risks and rewards shift. Variable consideration is included only if it is probable, ASC 606 or highly probable IFRS 15, that no significant reversal will occur. Contract modifications are assessed to determine if they create new contracts or adjust existing ones. And revenue is recognized either over time or at a point in time based on specific criteria. Robust internal controls, comprehensive documentation, and continuous monitoring are essential to mitigate legal risks in revenue recognition. Failure to comply with SOX and SEC requirements can result in severe penalties, including multi-million-dollar fines, criminal charges, professional bans, and reputational harm. Common pitfalls such as channel stuffing, premature recognition, and fictitious sales are aggressively prosecuted, making strong compliance frameworks and executive oversight critical. Robust internal controls, comprehensive documentation, and continuous monitoring are essential to mitigate legal risks in revenue recognition. Failure to comply with SOX and SEC requirements can result in severe penalties, including multi-million-dollar fines, criminal charges, professional bans, and reputational harm. Common pitfalls such as channel stuffing, premature recognition, and fictitious sales are aggressively prosecuted, making strong compliance frameworks and executive oversight critical. Post-implementation reviews by FASB and IASB found ASC 606 IFRS 15 effective with ongoing clarifications needed. Emerging business models including digital assets, SaaS, and platforms create new challenges in identifying performance obligations and transaction prices. Persistent implementation challenges involve judgment in variable consideration, principal versus agent assessments, and contract modifications. Current practice trends show companies leveraging automation, formalizing pricing strategies, and enhancing contract management for complexity and compliance. To ensure compliance and minimize risk, organizations should implement and regularly update revenue recognition policies, maintain strong internal controls and documentation, provide comprehensive disclosures, stay informed on industry-specific guidance and emerging issues risk assessments. Revenue recognition is a cornerstone of financial reporting, governed by ASC 606 IFRS 15's 5-step model and subject to strict legal and regulatory oversight. Companies must exercise significant judgment, maintain robust internal controls, and stay abreast of evolving business models and regulatory expectations. Failure to comply can result in severe penalties, making diligent application and continuous monitoring essential for both accounting accuracy and legal compliance. Okay, now let's practice a bit. What was one of the main findings from post-implementation reviews of ASC 606 IFRS 15 by standard setters? A companies found the standard too simple to implement. B, the standard eliminated all revenue recognition issues. C, implementation required significant judgment and resulted in diverse practices. D, all companies adopted identical revenue recognition policies. Correct answer: C. Explanation. Reviews showed that while the standard improved consistency, it still requires significant professional judgment, leading to diversity in practice. 2. According to recent FASB guidance, which area continues to require the most professional judgment under ASC 606? I. Identifying the contract with the customer. B. Determining the transaction price, especially with variable considerations. C. Recognizing revenue when goods are shipped. D. Recording cash receipts from customers. The correct answer is B. Determining transaction price, especially with variable consideration, remains the most judgment-intensive area. In the next lesson, we will explore expense classification and its legal significance in greater depth.